People often say that in a gold rush, the best way to make money is to start selling picks and shovels. After racking up crippling credit card debt buying pick and shovel NFTs, I've decided there may, in fact, be a smarter way of getting exposure to cryptocurrencies, NFTs, and all other Web 3.0 goodies. In this video, we're going to take a look at Coinbase, the company which I believe to be the best picks and shovels opportunity in the current crypto gold rush. As many of you know, Coinbase is the platform where you can buy and sell various cryptocurrencies. Currently, Coinbase makes its money by charging a fee anytime you buy or sell cryptocurrencies. This means Coinbase can make just as much money when Bitcoin crashes as when it surges. It also means Coinbase can earn money when Shiba Inu rockets 1,000,000,000%. This component of the business is attractive as it's a beneficiary of wider cryptocurrency adoption rather than being singularly linked to the performance of Bitcoin. This part of the business isn't well understood by the market, and often the price of Coinbase shares directly correlates with price fluctuations in Bitcoin and Ethereum. This disconnect with the share price being linked to the cryptocurrency's prices, and the business performance being linked to the beta, or volatility of traded assets, has in my opinion created a disconnect between the current share price and the underlying value of the business. Let's dive deeper into the core business units of Coinbase. The most profitable segment of Coinbase is unsurprisingly the cryptocurrency trading segment. Coinbase services both retail and institutional investors, allowing both to buy, sell, and hold cryptocurrencies. Coinbase has been rapidly growing its monthly transacting users for the platform, increasing users by over 300% year-on-year to 7.4 million users. This has led to the quarterly trading volume exploding by over 700% year-on-year to $327 billion. This segment accounted for 85% of the business's revenue in Q3, clocking in at $1.0089 billion. It's worth noting that this is a decrease from the previous quarter. I'd contend this drop in revenue and trading volume is due to trading trends being volatile month to month in cryptocurrency land. However, Coinbase is expanding into a secular growth trend, and as such, the long-term trajectory here appears very positive. Looking at the revenue breakdown, it's clear that even though institutions accounted for a far larger percentage of trading volume, they only accounted for a small portion of the net revenue. This is likely due to Coinbase allowing these large institutional clients to negotiate far more favorable rates due to the scale of transactions and potentially even future cross-sell opportunities available in that segment. From my perspective, the retail market is also more interesting than the institutional market, as the margins will probably remain stronger for longer. However, it's also worth noting that other segments of the business will benefit from having these institutional clients, such as the subscriptions and services segment and the Coinbase Cloud segment. The subscriptions and services segment is the other primary component of the business that Coinbase reports on separately from a financial point of view. This component of the business accounted for approximately 11% of the company's net revenue and has grown by over 13x year-on-year. The subscriptions and services vertical appears to be capable of generating a more reliable source of growing recurring revenue for the business when compared to the trading segment. The most exciting of these components, in my opinion, is the revenue from blockchain rewards. This segment is primarily fueled by taking a percentage of the blockchain network rewards leveraged by proof-of-stake cryptocurrencies, most notably Ethereum 2. I expect this segment of the business to grow at a faster rate than the trading segment over the next few years, as it'll be able to further monetize the high-volume, low-revenue institutional investors. Coinbase Cloud is possibly the most ambitious component of the business. Coinbase Cloud leverages its existing infrastructure to create a unified set of APIs to allow organizations to build applications that connect to existing blockchain networks. Coinbase Cloud offers everything from programmatic trading, abstraction layers for network interaction, and even processing of payments. This segment of the business is relatively new, and as such, it's hard to gauge the success of the product, but any traction in the space would likely be an exciting prospect given the success we've seen in cloud computing businesses such as AWS in recent years. In their third quarter earnings report, Coinbase highlighted the upcoming launch of Coinbase NFT. For those unfamiliar, NFT stands for non-fungible token and is essentially a tokenized version of a real-world item, such as art or music, that can be bought, sold, and validated on the blockchain. This new segment will be a marketplace where users can mint, collect, discover, and showcase their NFTs all in one place. I'm far from an expert in NFTs, but having a decentralized virtual token for ownership purposes is an incredible utility. Currently, it's primarily being used for the exchange of media such as artwork, video clips, and even tweets. But in my mind, this technology has far better use cases, such as becoming the backbone for exchanging the deeds for housing, or even exchanging shares and other securities. I think this segment will likely have fantastic synergy with the Coinbase cloud and trading segments to augment and further monetize the customer bases for these two verticals. Coinbase made its NASDAQ debut on April 14, 2021. As such, we only have 3 quarters of earnings to evaluate it on. Coinbase's trailing 9-month earnings add up to $11.09 due to its monstrous second quarter. Assuming a share price around $270, this means that Coinbase is trading on a PE, or price to earnings ratio, of less than 25. And this is even assuming that they only break even on their Q4 earnings, which I believe is unlikely, as they've been profitable in every quarter since their NASDAQ debut. The analyst consensus 12-month price target for Coinbase is sitting at $400 at the time of recording. If these estimates are accurate, that would mean Coinbase has more than 50% upside in the next 12 months. Looking at projected earnings for Coinbase, the analyst consensus expects Coinbase's earnings to have a pullback in 2022 before returning to growth in FY23. I've put together a valuation spreadsheet to try and model projected earnings growth to smoother values and then work backwards to something resembling the analyst consensus valuation. Let's take a look at that. In this model, we're assuming Coinbase grows earnings 50% in 2023 and then 10% annually from that point forward. We're then using a variation of a discounted future cash flows model to arrive at our valuation of $398. The key variables used in this equation are the discount rate and the stable state PE ratio. The discount rate is set to 4%, which is fairly standard as an input variable there. It's generally used to represent the long-term expected return available on treasury bonds, or what some people would refer to as the risk-free expected return. The PE ratio of 40 has been selected using Microsoft as a point of comparison, as they're both software businesses with strong margins, and they're likely to be able to both organically grow at rates between 8 and 15% per year. Okay, now bear with me. We're going to quickly dive into the math behind this valuation. I'll attempt to make this brief, as I definitely don't want to be the dude who solves math equations in front of the whole class. First step, shamelessly steal the analyst projected earnings for year 1, or 2022. We've done this as analysts appear to believe it's likely that the earnings move backwards in financial year 2022. We then took this number and modeled earnings growth for the future using our provided values. Finally, we smashed our values into this valuation formula that I found written above a urinal at a local pub. Running the numbers, we got a valuation around $398, which is fairly close to the $400 analyst price target. Having said this, I actually have a divergent opinion with analyst estimates. I believe Coinbase has the potential to grow at rates of 20% and above for the next few years, and then sustainably grow at an average annual rate of 10 to 15% for a sustained period of time. In this model, I've baked in a larger margin of safety by using a discount rate of 10%. I've used 10% as that is the average annual return I would expect to receive by holding an S&P 500 ETF. As such, if I'm going to take extra risk by holding an individual stock, I need to believe it will outperform the market rather than outperform treasury bonds. The PE ratio of 25 I've elected to use is comparable to Facebook or Meta platforms. I've selected this as I believe in the long term Coinbase will be in the same position as Facebook, a highly profitable, mature software business that has fully captured its market share and will either grow by increasing monetization of existing users or expanding into new verticals. This gives us a valuation around $350, which represents significant upside from the valuation at the time of recording, but is lower than what analysts believe the share is worth currently. To sum it up, I'm hugely bullish on Coinbase's future prospects and will be looking to add to my position while the price remains under $350. However, this area of investment is not without its risks, as we're still very early in the adoption cycle of cryptocurrencies, decentralized finance, and Web 3.0. Also, please remember this video is only my analysis of Coinbase, and as such, only represents my opinion. This video is not financial advice, and I'm certainly not a financial professional. You may want to consider seeking independent financial advice from a financial professional as well. Hope you all enjoyed the video, and feel free to hammer the dislike button if you hated it. Don't forget to subscribe and hit the notification bell so you'll be alerted when I drop my video outlining what I believe to be the top 5 growth shares for 2022. If you have a company you'd like me to go and do a deep dive on, then drop it in the comments. I generally feel pretty comfortable analysing most technology, retail, and finance companies, and I try avoid mining exploration and early phase biotech companies as I wasn't smart enough to get into med. Anyway, I'll catch you all next time. Cheers.